Welcome to J.K. Michael's Knowledge Series. This is the Career Improvement Series. Today we'll focus on financial management, and our topic will center on how to keep good personal financial records. To gain and retain control over your finances, one of the most important skills you can learn is how to keep track of your finances or money. This involves collecting, recording, and analyzing your financial data in order to recognize patterns and make informed decisions. Not only will it help you to recognize and address your spending and other financial patterns, it can also help you to take those key decisions that make the difference between financial dependency and independence. Keeping track of your financial data is crucial. All of your financial transactions are or ideally should be recorded in your financial records. As a result, your financial records should include your bank statements, receipts, transfer funds, investments, withdrawals, wages, mortgages, loans, stock, mutual funds, and insurance policies. In order to avoid paying any bills late and to achieve your financial objective, you must maintain track of all your financial documents. Keeping track of your financial documents is important for two reasons. It helps you properly manage your financial details to avoid any form of negative eventualities, and it helps you achieve your financial goals. Number one, managing your financial details. For a good illustration, let us assume that there is a small business owner or a working professional called Dio. To keep track of his financial records, Dio organizes all his documents into distinct categories, each into a file on his desk or a folder in his computer. He uses a spreadsheet to record and compute his finances periodically. He has files or folders for everything: stuff to review, folders with invoices and bills to pay, folders for record keeping, and folders for information that should be disposed of. Proper organization techniques help him to sort out and manage every detail of his financial life without missing any of the essentials. Number two, achieving his financial goals. Dio has financial goals that he has set out to achieve this year. To do this, he knows that he must maintain a budget. A budget helps him stay focused on his financial objectives. Dio's budget displays his monthly revenue and a breakdown of his expenses into the various expense categories. And this could include rent, utilities, groceries, savings and investments, entertainment, education for the kids, and so forth. To end each financial period with a surplus for savings and investments, Dio must ensure that his monthly costs are never more than his total monthly income. Let us assume that Dio makes $500,000 every month. He saves or invests 15%, and that leaves $425,000. He has a list of expenses, both recurrent and non-recurrent. He already sets aside perhaps $90,000 of this through the month. His rent at the end of the year is about $1 million, so that means he needs to keep aside 83,000 naira to handle this expense. For his annual vacation, he plans to take his family to Dubai. He keeps aside 50,000 naira, since his goals are projected at 500,000 naira for this trip, and it should take him less than 10 months to reach his goal. If he's a religious man, of course, he may budget in his contributions for his faith. The rest might go into short-term funding accounts for contingencies such as health and other emergencies. With this kind of structure, you will notice that Dio will hardly ever run into financial problems because his finances are well planned out. What kind of financial information should you keep to be able to gain comprehensive understanding of your current financial state, as well as track your future financial prospects? I'll break it down into three. There are documentations for the short term, which should be held for about a year or less. The documentations for the mid-term, which should be held for 3 to 5 years. And then, of course, long-term documentation, which should encompass anything greater than 5 years into 7 or 10 years. For the short term, you should endeavor to keep: number one, utility bills, e.g. electricity and water bills; number two, pay slips; number three, the bank statements; number four, investment records, especially short-term investments; and number five, credit cards and debt records. For the mid-term, you should keep income tax returns; number two, other tax supporting documentation at the federal, state, or local government level. Number 3, medical bills and cancelled insurance policies. Number 4, documentation for sale or purchase of a capital item, e.g. a house, a car, a generator, and so forth. Number 5, documentation for sale and purchase of stock. And then of number 6, annual investment statement. For the longer term, you might want to keep details of loans that you have paid off. I've seen situations where a politician's credibility was greatly enhanced when, close to the election periods, information came out that he was a good taxpayer and had up to 20 years records of consistently paying his taxes. There are also certain privileges you may not be able to access as a citizen of a country or as an aspiring immigrant into another country if you cannot provide statutory records such as tax records and such. Over time, you will understand that keeping financial records may save you from many heartaches in the future. How can you organize your financial information properly? We'll go through 6 steps. Number 1, have a specific place for keeping financial records. This could be a physical space such as an organized filing cabinet, deep desk drawers, or virtual spaces such as a secure cloud location or digital files and folders. Plan for the disposal of documents as required. Number 2, organize your data into categories. Know which records are active and separate them from the inactive or archived documents that are kept for future references. Active statements could include statements from the bank, an investment account, insurance policies, health records and warranties, capital purchases and RSA or retirement savings account details, wills and testaments, and as well as old tax records are all examples of inactive records. Number 3, rent a safe deposit box to preserve information or documents that have financial consequences yet may not be easy to replace if misplaced. Examples would be CFOs, marriage certificates, land titles, stock and bond certificates, burial plot papers, adoption papers, NYSC certificates, college degrees, etc. Alternatively, you may purchase a fire-resistant safe if this information must be stored at home. Number 4, always create a backup for important documents, especially for those that would be needed in the future for reference. Examples will include tax records, real estate documentations, e.g. CFO, and investment documentations. All of these should be backed up. It is often best to store your financial records by scanning important documents and encrypting digital records, and then you store any hard copies in a fireproof safe or a safe deposit box. Number 5, a huge part of record keeping is knowing what documentation has served its purpose or is now antiquated and has to go, and this should be shredded and wisely disposed of. Number 6, consolidate your financial information. Make a list of all your financial assets, liabilities, insurance coverages, financial advisor contacts, and other important financial information. When properly evaluated and consolidated into one statement, this is called the statement of net worth. Provide supervised access of this information to your loved ones and to the executor of your final will and testament. To summarize, in order to gain and retain control over your finances, one of the most important skills you can learn to be able to gain and retain control over your finances is how to track your finances. This involves collecting, recording, and analyzing your financial data in order to recognize patterns and make informed decisions. Not only will it help you to recognize and address your spending and other financial patterns, but it can also help you to take those key decisions that make the vital difference between financial dependency and independence. Keeping track of your finances is important for 2 reasons. First, it helps you to properly manage your financial details, and secondly, it helps you to achieve your financial goals. Financial documents should be kept in 3 categories. Documents for the short term, which should be held for about a year or less, documents for the mid-term, which should be held for 3 to 5 years, and documents that should encompass anything greater than 5 into 7 or 10 years. And how can you organize your financial information properly? Firstly, Have a specific place for keeping financial records. Secondly, organize your financial data into categories. Thirdly, rent a safe deposit box to preserve information or documents that have financial consequences yet may not be easy to replace if misplaced. Fourthly, always create a backup for important documents. Number 5, a huge part of financial record is knowing what to document and what documentation has served this purpose or is now antiquated and has to go. These must be shredded and wisely disposed of. Number 6, consolidate your financial information. For more information on financial management and more specifically maintaining your financial records, please check out our website www.jkmichaelspm.com. We have an endless stream of trainings, courses and materials to enhance your development. If you haven't yet subscribed to our videos, please like and subscribe by hitting the red button with subscribe on it down below. Now for my question, if you don't have the option of both choices, would you prefer to store your financial information physically or virtually? Please also give us reasons for your answers. Enter your responses in the comment section. We will go through your comments and respond or offer feedback as required. Thank you for watching this video. See you in the next video.